Welcome back, everyone, to another episode on Living Your Greatness. I'm your host, Ben Mumme. And if you're new to my show, please hit that subscribe button. Today, we have a new guest to the show, and his name is Tim McElvain. For those of you that don't know Tim, he is a value investor managing a value fund tailored for Canadian investors. Tim founded the McElvaine Fund in 1996. Tim also previously served as a chief investment officer at the Cundill Funds. So Tim, without further ado, welcome to the show. It's a pleasure to have you on today.
The pleasure is mine, Ben. Thank you.
So Tim, let's kind of get kicking here. Tell us a little bit about yourself. Where did you spend your formative years growing up? And what inspired you to go not only the investing route, but also create your own value fund?
Well, I grew up outside of Kingston. My parents had a small hobby farm, and when I guess I must have been about in my early teens, my mom and dad had the thought that rather than paying me an allowance, they would set me up in the chicken business. So the theory was dad would help with the capital costs, the construction, uh, and the acquisition of chickens. They would lay their eggs. I would sell them to the local neighborhood, and the proceeds, less feed, etc., would be mine. Well, it quickly went downhill. Not only did winter come and the eggs would freeze, we had the odd predator poach them. Plus, my mom would take the eggs without paying. So I quickly slipped into insolvency, and we had to liquidate the chickens, so to speak. So that that meant to me, I'm definitely not going to agriculture. So I kind of narrowed the list after that. But so I worked for an accounting firm in Toronto. I worked in Bermuda, and then met Peter when I wanted to come back to Canada, Peter Cundill, and then moved out west to work with him. So that's kind of the maybe a bit longer than you wanted, but that's the price. That's the summary of it.
So Tim, if we pinpoint on Peter Cundill here, he's one of Canada's, best investors in history, especially in terms of a value investor. And I know he was also one of your greatest mentors, and you just spoke about how he was, part of your formative years. What was it like to work closely with someone like him? And are there any memorable highlights, that you want to share with my listeners?
Well, I did a little tribute to him before he passed away. I'll send you a copy after Ben, and you can feel free to post it on your website or wherever, if you choose. But Peter was the most disciplined person I've ever met, but also kind of one of the best people I've ever met, if that makes any sense. He was a lot of fun to be around. He gave you a lot of scope, but he was there to help you if you needed. I don't know if that kind of summarizes. We can get into a little bit more on him specifically, but go ahead.
Pretty eager to actually dive, a little bit further because I know I've heard you say, I've watched a lot of your talks and, you've talked about his passion, his patience, and his
Yeah.
discipline. And, but when we start off more with, the investing side, in terms of principles, I know that the two things that really stood out for you that you admired was, the importance of simplicity. And then the other one was his patience and fortitude to go against the crowd. So to me, that sounds like a contrarian mindset. So why were these two, investing principles, so important to you?
Well, in fact, I might add a couple to them. So I, like if when I think about Peter, I think one about curiosity. He was curious not only about investing things, but everything from uh, yoga to running to art to poetry. He was a very curious guy, and that helped him in investing because he wouldn't dismiss something. Um, if someone thought it wasn't interesting, he would take a look. The second thing is his contacts in the investment community, and outside of it were significant. So Peter could go to a country, um, and Maureen, who kind of worked with him, would set up ahead of time, meetings with some of the top value people, uh, in that country. And Peter was very good at filtering through the information and saying, all right, what works for me and what doesn't work. And then he'd come back with a small handful of ideas. And I saw him do that over and over again. It's kind of a funny aside. Quite often he'd go in to meet company managements and I'd give him a long list of technical questions, but Peter would come out and he might have asked none of them. But he would have formed an opinion of what he thought of the person, what he thought about their trustworthiness, etc. So curiosity, context, and people skills, I guess I would say. Conviction, which kind of, as you said, to be a value investor, you're going to be going against the crowd, right? The only way you can get an attractive price for security is if it's unpopular. So as John Templeton, I think I said, you have to buy the stuff people are selling. So Peter had conviction. And then the final thing, as you talked about, was patience. Especially in value investing, things don't turn on a dime. So you have to be willing to wait. And I think that's one of the huge advantages individuals have too, is time's on your side. If you pick the right company with aligned management, time is your asset, not a liability.
Absolutely. Yeah, no, well, those are great, principles that he taught you. And I know it was also more than principles like that. I know he also gave you, a ton of other frameworks as well as mentorship, which is the greatest thing when we start a career, is someone that you respect and also someone that, you really want to maybe be like or kind of get pushed to be better.
Yeah.
And I know you also liked his hot dog business lunches as well. Am I correct about that one?
Yeah. Peter was well, had, as I said, he was a very disciplined guy. So he'd say, well, today, I can have a hot dog. You would have liked him, Ben. He was very fit. And usually, obviously, I'm not in the same fitness level as him, but he would save his hot dog and ice cream days, I guess, for when he had meetings with me. So we had a little bit of a tradition. So yeah, that was fun.
Sounds like there was a lot more to, just the business relationship, the investing relationship, with the life relationship, and that's obviously priceless. But Tim, something that I want to shift to here is, value vesting is what you really know, and so when we think about some of the most, top investment minds in the world, whether it's giants like Warren Buffett or Benjamin Graham or Charlie Munger, they really understood that, So for the benefit of my listeners, I'm curious to ask you, what exactly is value investing? And, can you talk about, your story that you've told many times on Mr. Spock and Homer Simpson? Because I feel like that is a good, mental model or even framework for the margin of safety and why that also contributes to value investors.
Yeah, uh like as you alluded to, Ben, there's a lot of different ways to skin the cat, so to speak, if I can say that. When I first started, I thought there was only one path uh, to value investing, but as you go on, and Peter understood this, there are many different flavors to it. But the key thing is you're buying something for less than it's worth, and less than it's worth is determined, to get a little bit back to an earlier question, in a relatively straightforward manner with very few variables. Like one of the things when I worked with Peter, whenever we hired a new analyst, they would do very elaborate models, and my comment to them was always, don't tell me 20 reasons why the stock's interesting. Tell me the most important three or four. And that's what I think that's what Buffett and Munger were so great at, is saying, all right, what are the key assumptions or key variables in this? And everything else is noise. And the Spock versus Homer Simpson analogy, I thought was just that, when you determine what a company's worth, you should use kind of a Spock-like mentality, right? You're being very analytical, so to speak. And the market is run by, and this isn't meant in a derogatory way, but is meant like Homer Simpson's of the world, very emotional, gets up, gets down. And so your single purpose as an investor is to take the Spock-like estimate of value and wait for a time when Homer Simpson's willing to sell you at something at a big discount to it. And that's when you do. And the rest of the time, go away and do something else. Uh, don't fiddle too much.
Right. So that makes me think then if we want to be careful about being, the Homer Simpsons, what are some mistakes that they need to be careful about?
Well, the biggest one probably is getting dragged into the kind of internet of ideas. For example, I'm always impressed with the number of people who have an opinion on the valuation of Facebook or Google or Apple. And from my point of view, why bother? Your competition, so to speak, your analytical competition is so huge on those ideas. So unless you're investing $100 billion, you don't need to have a view on it. So take all of that brain power and energy and apply it to a situation where you have a competitive advantage. Some Charlie Munger refers to it as a circle of competence. I view it a little bit differently. I'm just saying try and look for those situations where the sellers don't care about what price they're getting in the security. Maybe it's geographic, maybe it's disappointing, maybe it's a sector. And then you can go in there and you have a competitive advantage. You're coming in where everyone's acting irrationally, and you can come in and say, all right, what's interesting here? And I think that's so important. So pick your spots and make sure you're playing your own game. As someone once said, the stock market's a very expensive place to find out who you are. So if you have a certain temperament, um, like you might get a little bit nervous at the first sign of trouble, even though you're sure about your facts, then don't have 10% position sizes, right? Then maybe do a little bit smaller position sizes so you can live with it. If you feel very against fossil fuels, then don't force yourself into that area. Look at something else. So I don't know if that helps a little bit, but look for a competitive advantage on the purchase and play to your own strengths.
I think that does help because I do believe that people should always invest in what they know rather than what they don't know. And that kind of makes me think of, asking you a question about, how do you view the impact of narrative economics, driven by social media and, the herd mentality on investment decisions? And what strategies do you employ to avoid, a falling trap of chasing trends?
Well, the first thing is, someone asked me the other day if I was worried about the passive index movement. And I said, no, I view it as the Value Investor Employment Act, so to speak. Because whenever people are disregarding a group of securities, there's going to be opportunity. So, as you talk about with the internet and momentum, as I said, you don't need to have an opinion on those things. Look at other areas that perhaps aren't well covered. Did I address your question, Ben, a little bit? There was part two of it, but I seem to have forgotten what it was.
No, I think you did answer. I think the biggest thing that you said was like, try not to let that bother you, right? In
Mm,
terms of all that noise, right? And I think that's the most simplest thing that any investor can do. And that goes to what we were just saying before, like stick to what you know, rather than get caught in all the emotions and being like, the Homer Simpson, right? Um,
yeah.
so that actually makes me think, okay, if we're trying to be more emotionally stable, right? Because that's a big part of the investing game, right? Behavior economics. When I think about someone who's had a huge impact on my thinking, not only investing, but just in terms of, the world. And I know someone that we have in common, Shane Parrish, he's big on frameworks, and I am too. And I want to start off before we hop into frameworks for value investors. I think there's one that you've created that I really appreciate, which is called Abba. So, can you tell us about your girlfriend Abba?
Well, sometimes it's interesting. The business is an interesting business because people um, want you to be uh, very intellectual in your comments, and I start to talk about Homer Simpson and Abba, so you can see why I run a small business rather than a big one. But Abba is a very simple way, I think, of breaking down what we do, and it's an acronym, of course. So the A is what I call accident, and it gets to what we were just discussing, which is what's your competitive advantage? Why is there a dislocation in the stock? Why are there sellers not thinking about price? So what's gone wrong to give me an opportunity? Um, you don't want to find out that you're the patsy at the table halfway through the game, so to speak. So that's the first thing, the A. The B is, simple bird in hand, making sure that you know what a company's worth and that it's less than that. And one of the things we talked a little bit about Cundill was you also try and figure out a little bit what direction that value is going, not making a forecast, not doing a spreadsheet on the company, so to speak, but rather just saying, is it getting better? Is it getting worse? So that's kind of like bird in hand, bird in the bush, but that's the B. The next B is what I used to call a brick house. I had a lot of kids, and there's a story of the three little pigs. So in investing, all of my mistakes have come from being in straw huts, uh, or even in stick huts. So I want to be in brick houses. So that's what the B is. So what you think about there is, what's the financial structure look like? What's the competitive advantage? What's the free cash flows? And also, as Peter used to talk about a little bit, is there an escape valve if something begins to go wrong with the company? And then the final thing is alignment of interest, which I've served on a number of public company boards, and there's a difference between investing with professional managers and investing with owners. So when you go in, you want to make sure you understand who you're investing with and what the alignment is. Ideally, they have real skin in the game beside you, because I think that it won't help at the margin, but when they're making key capital decisions, that's when the alignment's important. So that's ABBA: accident, bird in hand, brick house, alignment.
Well, I appreciate that explanation. And, it makes me actually want to tap into one of the ones that you spoke about, which was accident, right? And, there's a famous quote, that I've heard before by Charlie Munger, which is, you have to fish where the fish are, right? So how has that concept, when you're thinking about accidents, how have you applied that in terms of your decision making?
Well, as I said, yeah, and Buffett also talks about buying a great company in the moment of when it's having difficulty as another example of that. So I think they're both talking about roughly the same thing, which is does what's the seller thinking? So if you buy shares of an IPO, you can bet that management, shareholders, everyone on the other side of the IPO has thought carefully about getting the best price possible. Um, where's your competitive advantage there? You're basically having to assume either they've misunderstood the value of their own company that they're selling to you, or the future is going to be better than everyone thinks. That's a tough battle to win. On the other hand, if you take a situation, where there's a ton of bad news around it, maybe in the crisis of 2008 and 2009, when Wells Fargo, which Charlie Munger famously bought, was getting beaten down. The sellers there just went out. So Charlie Munger was able to say, all right, um, this is what I think it's worth. This is why I think it'll be around. And this is why I trust management. And he went ahead and purchased it. So that's kind of what I'm talking about with accident. Just making sure that the person on the other side of the trade doesn't have more information than you do.
I appreciate that answer, Tim. Something that I'm curious is, I know you don't pay attention a lot always to, you know, the macro picture or the noise that's going on in the world. And I know as a value investor, you really focus on, the companies, right? Like the value that they are, whether it looks different in their share price. So how do we really know, though, a company is of value if we see it's been beaten down?
It's a good question. So when a new idea comes up, um, the first thing I look at is just thinking, uh, roughly, does it look like it's trading for less than it might be worth over time, like say in three years? And does it look like it'll easily be around in 3 years? And is there someone there who cares more about how it does than I do? So kind of the alignment of interest. Now there are things that you can't control, like the political environment, um, the economic environment. So you have to kind of identify those as risks, but just figure out, is that going to mean that my value is going to go to zero, or does that just mean um, it might take a little bit longer to work out? I might be worth a little bit less. So I don't know if that answers your question, Ben, but if it gets too hard, then don't kick yourself, say, "Oh, I'm not smart enough to figure this out." It just means maybe there's no easy answer and go on to another thing. And as I said, unless you're managing billions and billions of dollars, there are what, you know, thousands and thousands of securities out there, so you can move on to a different one.
Yeah, no, you definitely answered my question there. And I think too, in one of the previous questions, when you're also looking at a company, right? You already kind of said it, but you're looking also at the management team if they have skin in the game, right? So there's a lot of other elements that you're looking at even before making that
Yeah,
decision.
yeah. Actually, if I can add something, because I think it maybe illustrates it a little bit. In 2011, just after the earthquake, and just before too, because I went there twice, I went over to Japan because the Nikkei was being clobbered. So, and we ended up with, I don't know, well over a third, I think, of the fund in Japanese securities. So the Nikkei was about whatever 9,000 or something like that then. So then I did a conference and I thought, all right, it would be interesting to have a market strategist come and talk about Japan, and basically give the negative story. And then I would come in and say, because of this negative story, we were able to buy all of these securities cheaply. Well, the problem was, and the huge flaw in my logic was, this guy had done probably 1,000 presentations, and I had done maybe half a dozen. So he was a very compelling speaker. And by the end of the conference, people I think were petrified by the securities I own because the macro story was so negative. Now, of course, 10 years later, and in fact, I had some redemptions after that, sadly. 10 years later, the Japan is almost, uh, you know, 4 times higher than where it was. But the negative macro story can often be very compelling. You have to say, am I willing to wait that through or not? Sometimes they're right too. So you can't be contrarian just to be difficult. Is
Totally. No, I understand that. Well, I appreciate that example. And something that I'm curious to ask you is like I feel like the strength of really good value investors is they know how to evaluate, when it's cheap, when it's a good opportunity to put themselves in a good position. But I am curious to ask you, what about the strategy in terms of exiting? Because typically most value investors are patient, assuming that the company is meeting all of the needs of what they're looking for and performing well, where they don't have to, reconsider their investment thesis. So how do you go about, if it is a really good company and you made the right decision, how do you ever go about, in terms of exiting your position?
it's a tough question. Peter had a basic rule, as you talked about in an article you wrote, to sell half when it doubled. Now, that's completely um, not based on any science or anything like that. It was just something Peter felt important to get your money off the table after that, and then you can let it run. I haven't been quite as disciplined on that, and sometimes it's worked to my advantage, and sometimes it's worked to my disadvantage. Usually, the things I'm looking at is of course, what do you think it's worth, um, and what are the alternative opportunities available to you. Like John Templeton used to say, only sell a stock unless something's gone wrong. Only sell a stock unless you can buy something twice as cheap. So it's kind of a combination between both. I think that is one of these things I got to before, which I said you have to play to how you feel personally. The tough thing is when a stock goes up, you're of course inclined to believe the good stories. And when a stock goes down, you're more inclined to think, oh, did I miss something? So you have to be a little bit balanced on both of those.
Something that I want to shift to is I know both you and I are big on mental models, and I know Shane Parrish has, had a big impact on, your thinking. So a question that I have is, of all the mental models that are out there that have ever, come onto your plate, which are the best of the best that you've applied in terms of the investing world?
Hmm. Well, I think I kind of point to two of them, and I think once again you've talked to this about this as well, creating the environment that supports what you do, and a friend of mine, Guy Spears, talks about this. Um, I think Monish talks about it a little bit as well. There's an awful lot of distractions in the investment world. So you have to figure out, how do I protect myself against some of these? One of my arguments against some of the large firms, of course, is that they might manage many portfolios. They might have a marketing kind of obligation as well. So they are in an environment where they really don't control what they do. Compare that to someone like Warren Buffett, whose famously schedule is completely open, and he carefully controls the environment he's operating in. And I think Shane talks about this a little bit. And the second thing, which I think is a really important concept of Shane's, is, and once again, I think you mentioned it, is positioning. Um, the idea that you're ready for the next action, whatever it might be, is so important, rather than being defensive when you should be offensive. So, people ask sometimes, why do value investors have so much cash? And my view is you always want to be in that position to take advantage of stuff. You don't want to be in that position where you're having to pay defense when you ought to be doing something. So environment, positioning would be the two key things.
I believe, some of the best investors, right? They position themselves to, master their circumstances. And essentially that was one of the points that you just brought up. So do you have any stories, that you want to share with us when you, position yourself properly, to take advantage of the right opportunity?
Well, uh, I'm trying to think of something that comes to mind. Like I can say kind of like a Cundill story. Peter would get the valuation once a week. When I worked with him, email was just starting, so he wouldn't really we wouldn't really communicate often via email. He didn't really look at stock quotes on a day-to-day basis, and he could be very difficult to get hold of at some points in time. So here was a gentleman who, as you pointed out, has had a great record, and was very disciplined about protecting himself from the things that are so accessible today. Uh, Stock quote, stock opinions, a minute-to-minute valuation of what you're doing. All of this stuff he had kind of pushed away from him. And I think that's probably the best example. So like everyone else, it's tougher now, right? Because you can get notifications, you can get all types of stuff coming at you. But I try and keep the things that don't matter away. And one of those is really, as I said, a minute to minute stock quote. So like I don't have a Bloomberg. There's nothing flashing in the background. I can go to the bathroom and not worry that I missed a uh, you know 5 cent move in one of the stocks, because we really have a multi-year time horizon. I would like if they went up quickly, but as a value investor, they seldom do. So play to your strengths. Keep away from noise that doesn't help the investment decision. and keep from causing yourself to take an action that you might regret later because of some external, uh, whatever.
My next question that I want to go to that I've asked a lot of my, investing guests is, you've been in the investing world for a while now. You've had
Wild, yeah.
great mentors like,
I had hair when I started in it, like not quite as good as yours though, Ben, but
oh,
but cherish it while you have it.
thank you, I will. And yeah, I guess my question is, over the years, you've obviously learned lessons through both success and failure. But what do you believe separates, a good value investor from a great value investor?
I think Howard Marks has talked about this from time to time that maybe there are only a few moments in a few moments over the course of a year or over the course of a number of years where you actually have to do anything. So probably all of us, myself included, every day or every month try and find a new idea. Well, I've often thought there were those moments in time where you're best just to do nothing. One of the things Peter was good was uh, he really stayed out of the day-to-day portfolio management. It was only when something was going on, he'd hop on an airplane and go there, and then we'd go all in. So it wasn't concentration in that he had three stocks. It was concentration that we had a lot of Japanese, or we had a lot of German, or we had a lot of Latin American debt, or whatever. So I think you're going to have years when you do that. You're going to have years where you're obviously lagging and doing different things from everyone else, but you're going to have positioned yourself and set yourself up well for those moments in time when there's great opportunity. So I think, and Buffett would be the same way. You don't see him uh, buying and selling new securities every week. He just waits for those moments in time. So I think that's probably the biggest thing, Ben, and it's the toughest thing is really wait as Buffett says for that perfect pitch, and the rest of the time, as you do yoga, uh, go running as Peter did, whatever to keep your mind on other things that are probably more important.
I definitely agree that there is, you know, a lot more than investing in life, right? And yes, you want to get good at it. Yes, you want to do well, but you also don't want it to distract you, from all the other amazing things that there are in your life, right? And that kind of leads to, the question that I asked, all my guests when they first come on the show is, what is your definition of greatness? What does that mean to you?
Um, well, if you have children as I do, having them kind of go into the world being uh, confident and good people, that's important. No one on their, well, I'm sure some people do, but most people on their deathbed, think more about what type of um, whose type of lives have I touched going through. So if you have kids, that's important. If you don't have kids, or even if you do, friends and relationship. Peter had a great set of contacts through the world, and he was good at that. And um, I think that's another side to greatness is just making people who you've touched, making their lives maybe a little bit better because of your interaction. And, building up rather than building down. And and once again, I'll pull it back to Peter because that was kind of the gist of it. He dealt with some real scoundrels over the years. And for sure, he knew who to party with and who to invest with, so to speak. Um, but I never really heard him say bad things about people. He was really positive in that way. And I think that's part of greatness as well. Um, you know, doing well for people who have trusted their capital with you is super important, and that's something that's very important to me. But that kind of gets into almost the relationships. Treat people well, um, look for the best in them, and give them your best too.
That's a beautiful definition. One of the elements that you said is, being a people artist. And for those that don't know the term, is coined by Peter Hart, who is, a famous artist from actually Montreal, but even known across the world, who's actually been on the show. And it's bringing out the best of others, right? And it sounds like Peter did that not only with you, but in a lot of his relationships, right? And relationships matter, right? And that's definitely part of not only business, but parenting and beyond, right? So what is a book that you think holds, value for investors to read? Because I really believe that, knowledge is so valuable to people.
Well, if you went at the most simplistic version, it would be what's that story? The emperor has no clothes, because that's really everyone being of one mindset when the truth is completely different. So that kid's book, but more to your point, yeah, I grabbed two because I thought you might ask me. There's of course Shane's book, Clear Thinking, which I enjoyed, and if you haven't read it, then Christopher Riso Gill's book on Peter. I think those are two good books, and I think they kind of overlap a little bit because they're dealing with discipline, environment, um, positioning, etc. And then, of course, there's the other zillion books that people always refer to, Intelligent Investor and stuff like that. But they might be they're the two I have at hand, Ben.
Yeah, those are both great books. I have them actually here where I am as well. Tim, who is a future guest, someone that you know personally that you would love to see on this show?
Well, if you wanted a very disciplined and eclectic investor, would be someone like Larry Sarbet, who I think he's retired now, but Larry famously had huge cash balances at important points in time, uh, and and uh, and he's actually, I think he might be. I'm not sure about this. He might have studied sociology or geology initially, because he has a really good framework around how the environment in many cases created the cultures that First Nations or other people developed after that. So I think you'd enjoy talking with him, Ben, and um, and I'm happy to provide an introduction if you'd like.
That's awesome, Tim. Where's the best place, for my viewers, to follow your work?
Well, you know, I appreciate what you do, Ben, and it's part of this kind of relationship stuff we were talking about. Every podcast you put out is positive, uh, and you've and even by inviting me on it, you're kind of reaching into the depths of the unknown, so to speak. So I appreciate that. Avaluefund.com is my thoughtful website. I used to say McElvain.com, but my wife pointed out to me that no one, including herself, can spell it. So she said, go simple. So avaluefund.com, and they can find stuff there, and you're more than delighted to subscribe. But I know I'm definitely subscribing to you, Ben. So I look forward to seeing what future guests you have on here as well.
I really appreciate those kind words there, Tim. They mean a lot. And is there any last things, before we sign off today that you would like to add?
Yeah, no, just kind of what we talked about. But play your own game. You don't have to do what other people like. If you know one dance step, that's fine. Sometimes you'll look foolish, and sometimes you'll look like you should be on Dancing with Stars. But just uh, be confident in yourself, and try and avoid the noise, both in investing in other parts of life too, I suspect.